Hey everyone, and welcome. Today, we're jumping into a really powerful principle for building actual wealth, one that completely flips the script by measuring success in weight, not dollars. We're going to explore how to stack ounces and why it's such a fundamental duty for anyone who's serious about their financial sovereignty. So, here's our game plan. We're going to start with a mind-bending paradox, then shift into a crucial new mindset. We'll define what ratio playing actually is, walk through 5 specific plays you can use. I'll give you a critical warning to watch out for, and then, finally, we'll talk about your new scoreboard.
All right, first things first, we have to really understand the problem that we're trying to solve here. So let's dive into something I call the profit trap paradox. I know, right? It sounds completely impossible. How can you literally double your cash and somehow make zero profit? Well, this question really gets to the heart of a major flaw in how we're all taught to think about wealth. The answer, you see, isn't in the numbers themselves. It's in the nature of what you're actually holding. And here it is, the core distinction. On one side, you have money. We're talking real, tangible assets like gold and silver, things that are designed to hold on to their purchasing power. But on the other side, you have currency, specifically government-issued fiat currency, which is really just a debt note that's literally designed to lose its value over time. So when you sell real money for more currency, you haven't actually gained wealth. You've just traded a stable asset for depreciating IOU.
So, to get around this trap, you need more than just a new tactic. You honestly need a whole new mindset. Let's look at how shifting your focus builds a much more resilient and, frankly, smarter approach.
Most investors are what we'd call price sensitive. They're completely glued to the daily dollar swings. They measure their success in currency and they walk right into the profit trap. A value-centric investor, on the other hand, learns to tune out that dollar price noise. Their one and only goal is to accumulate more weight, more ounces of the actual asset. That's it.
Okay, so this value-centric mindset gets put into action through a very specific strategy. So let's get into it. What exactly is ratio playing?
In a nutshell, ratio playing is a core fiduciary duty. It's all about tactically moving between different forms of wealth to capture when one appreciates relative to another. And the goal is incredibly simple. Increase your total weight of assets, but do it without adding any new fiat currency or relying on fiat interest. You let the market do the work. Let's make this super concrete. Imagine you start with 10 ounces of gold, and you notice the gold to silver ratio hits 77-1. That means silver is historically really cheap compared to gold. That's your signal. So you swap your 10 ounces of gold for 770 ounces of silver. Then you just wait. The market does its thing, it swings, and the ratio drops all the way to 53-1. Now you make your move, and you swap all that silver back into gold.
And the result? You now have 14.52 ounces of gold. Think about that. That's a 45% increase in your holdings, a gain of over 4.5 ounces, paid for by market volatility itself. You didn't add a single dollar. This just perfectly illustrates the power of letting the market pay you in ounces, not in dollars.
And hey, this isn't just some theory that only works for gold and silver. This strategy can be applied across a whole bunch of different asset classes. So let's check out 5 actionable plays you can use right now. First up, the digital to physical play. It's a bits versus atoms strategy. With an asset like Solana and silver trading at near parity, you can use the speed and volatility of the digital asset to accumulate physical silver. So if Solana, your bits, jumps 20% while silver stays flat, you swap those bits for physical atoms, and boom, you've just increased your physical silver weight by 20%.
Okay, next is the production backbone ratio. This is really cool. Think about it. Silver is a key industrial metal, right? Industrial throughput. And oil is the energy that powers all of that industry, energy throughput. Their prices are deeply, deeply connected. And if you watch the ratio between them, you can find some really powerful opportunities. The signal here is just crystal clear. When oil and silver are at parity, a 1-to-1 ratio, you just hold. But if oil suddenly gets cheap relative to silver, say it drops to a 0.75-to-1 ratio, that's your cue. You swap your silver for oil claim notes, something like warehouse receipts. This positions you perfectly to swap back when the ratio returns to normal, letting you capture the difference in real weight. All right, play number 3 is the negotiable instrument play, and this is a big one. Not all silver is created equal, not by a long shot. While generic silver bullion is a commodity, and it triggers all sorts of reporting requirements when you sell it,
American Silver Eagles have a very unique legal status. They basically offer a legal escape hatch. And look, this isn't some weird loophole. It's written directly into U.S. law. Under Title 31, American Silver Eagles are legally defined as U.S. currency. Why is this so crucial? Well, because transacting in currency doesn't trigger the same 199B reporting you get when you sell a commodity, like bullion. It gives you a private legal path to liquidation. Our fourth play is all about utility. I mean, gold is great, but let's be real, you can't buy a cup of coffee with a 1-ounce gold coin. Goldbacks solve this problem by creating spendable, small-denomination physical gold. So when the gold-to-silver ratio drops, you can swap that bulky silver bullion for these incredibly portable and usable goldbacks, and you capture what's called a utility premium. But, and this is a big but, before you start swapping all your assets around, there is a critical warning we absolutely have to cover. You must be able to distinguish between investment-grade assets and high-premium collectibles. This is the premium trap. Let's just use silverbacks as a case study here. Now, these are often marketed right alongside sound money products, but they are classified as art, not money. They contain about a dime's worth of actual silver, but they sell for $10 or more. I mean, do the math. That's a premium of nearly 10,000%. This chart makes the trap painfully obvious. The tiny little bar on the left, that's the actual metal value. The huge bar on the right, that's the retail price. You're paying 100 times the intrinsic value. The math for stacking ounces is just completely broken before you even start. So this leads to a hard and fast rule, and it's non-negotiable. As the fiduciary of your own treasury, you never swap low-premium, investment-grade bullion for high-premium collectibles when you're ratio playing. It is a guaranteed way to lose weight and just destroy value, period. So let's bring it all home. After avoiding all the traps and executing these plays, how do you actually measure success? Well, it starts with a completely new scoreboard. This, right here, is the ultimate takeaway. Your goal is so simple. End the year with more weight than you started with. If your ounce count is higher, you are winning, no matter what the squiggly lines of the dollar price say. You have successfully used the market itself to increase your holdings of real money. And that really leaves us with one final question. When you truly think about preserving your wealth for the long term, what are you counting? Is it the fluctuating, depreciating currency in your bank account, or is it the physical weight in your treasury? The choice you make there really does determine your financial future. Definitely something to think about.